Good morning, Mr. Bob Dhillon. Thank you very much for doing this again. I really appreciate your time.
Well, I think I've arrived if I'm getting an opportunity to do this twice with you, second time on your podcast. And so thank you very much.
As a reminder to the listener, you are the CEO of Mainstreet Equity, but maybe to get it from the source, what is Mainstreet Equity?
Mainstreet Equity is a consolidator and add value of mid-market apartment buildings in Western Canada. So when we buy these rundown apartment buildings and we fix them up and improve the life of middle-class Canadian. And we've been doing this on the TSX for the last 25 years.
And for context, the current market cap of the company is about $2 billion, and you have about 19,000 apartments, if I'm correct.
And $815 million in liquidity.
Which we'll get into. So Mainstreet is also an example of a Canadian company that is actually building things in the country, making things better. So it's an example of Build Canada, I think.
We've hit two folds. One, we've achieved double-digit returns for the last 25 years, and that's from the investor's perspective. And on the social front, we've improved the life of middle-class Canadian because of the supply of affordability. The only way 60% of the Canadians who make less than $50,000 a year cannot afford these brand new condos and these shiny new purpose-built apartment buildings, which require a rent of $2,500 to $3,000 to justify a return for the developers. The reality is they have no choice but to live in these MERB-built late 70s, early 80s apartment buildings. But they all need a little bit of tender, loving care. And because they need all a little bit of tender, loving care, we've built a business model around mid-market, add value, Western Canada.
And it's been a good business for yourself and Mainstreet shareholders. We have a graph here. The company went public in around the year 2000 on TSX, and since then it's outperformed a bunch of indices, including the S&P, TSX Real Estate Index, RBC, Amazon, a bunch of other metrics. So how's that happened, and how have you been able to do that?
It's like making curry chicken, Trevor. Like it takes a lot of ingredients to make a perfect curry chicken, right? So it's not like grilling a chicken on the barbecue and here it is with a little bit of barbecue sauce. So a lot of the ingredients on Mainstreet's double-digit success and outperforming all the indexes has been: one is our management team, two is a business model, and three, sometimes you got to be at the right place at the right time. And we rode the wave. So I don't want to take full credit for taking the stock from opening bell of a private placement of 75 cents to hit a high of over $200. But it's a combination of everything that made it a success. But there was an opportunity to consolidate this neglected space called the mid-market space, which is 80% of the total supply of apartment buildings. What I mean by that, the institutional capital, the REITs, concentrated around the 20%. 20% of the total supply, bigger complexes. And the smaller buildings were kind of neglected. And the owners, profile of the owners were mom and pop who didn't have the systems, maintenance, renovation, and ability. For some reason, they own an apartment building or two apartment buildings. We're trying to standardize them, set some systems, security, renovated units, maintenance, all the things that 20% of the high-end apartments have. So we providing the same level of service.
Some companies have too much attention on them, and as a result, they're overvalued. But in Mainstreet's case, if I'm correct, the company's been, you could argue, undervalued and maybe not enough attention. Why do you think that has been, and how do you work towards getting more eyes on the stock?
Yes, that's been, if I had to pinpoint one challenge in Mainstreet, was less eyes on it. But the eyes who have been on it turn it to the best performing stock. So it's a kind of a contradictory statement. But the reason being is the capital markets, as we are listed on the TSX, created a product which is called the REITs. REIT, Real Estate Investment Trust, is a retail product where investors, mom and pop, wealth management, seniors, a very dividend distribution driven product. So they're looking for their 5% or 4% or 7% distribution, and the whole focus has been on the REIT segment. And we are a Corp. And we are the only Corp on the TSX focused on real estate. There's probably some other ones, but I just don't remember. And why that's an important distinction, the Corps take all the cash flow that we make, reinvested in improving the life of middle-class Canadians we have a spec and we have a model that we reposition these buildings to build a company. Now, why that's important, that's one of the ingredients of curry chicken I want to get into, is when we reinvest that cash flow to keep increasing the net asset value through cash flow and net asset value by acquiring more assets, obviously the company's value continues to grow every year and the stock will grow every year without diluting our capital structure. So when we went public, we had approximately 8.9 million shares outstanding, and now we are almost at a $4 billion asset base, almost 19,000 units, and $815 million worth of liquidity with 9.3 million shares outstanding. And the additional 300,000 or 400,000 shares were management options, one-time options we exercised. The point I'm trying to make is we went from zero to almost $4 billion in assets without any equity dilution, with still a lot of juice left in the NOI, what we call is the NOI catch-up. What the NOI catch-up is, we traditionally buy buildings that we can add value to. That means every year we approximately grow by 15%. And that 15%, one, is non-dilutive. Two, we're repositioning that 15%. So 15% of 19,000 units, you can do the math in your head, are going through repositioning, rental upgrades, market-to-market rents. So we've got approximately over $47 million of NOI catch-up. That means on same-store NOI basis, we have, if I don't grow at all, we've got a $47 million potential upside. Now, they may take a couple of years, 3 years, and there's Landlord Tenancy Act, there's renovations that's going on, there's lots of moving parts. But that's one pillar, is a $47 million NOI catch-up. The second is $815 million worth of liquidity to grow non-dilutively and without issuing any more equity. And the third reason, which is a recent phenomena, and you can go through the plans on that, there's been density and zoning changes that is happening right across inner city locations. So what does that mean? That means now you can go build a 27 or 47-story condo or apartment building right next to all our buildings, which is happening as we speak. So how does that affect us? Pretty soon, the land's going to be worth more than the NOI. So let's talk about NOI, net operating income. Net operating income, you take your revenue minus your expenses, you get net operating income. Then you put a cap rate on it. Unleveraged, that's an unleveraged return. And that unleveraged return, let's say the market gives you 4, 3, 4, 5, 6%, whatever the analysts decide to give you that day, is the value of the building. The land's going to be worth what the NOI value is. Why? Because if developers generally pay land costs per unit, so they can put on 1,400 units, right, and they want to pay $50,000 to $100,000 a door, that's simple math. Now, that's how density changes affects our balance sheet. So, as you see here, first it started out as we clustered smaller apartment buildings in inner city locations. Why did we do that? Is for operational reasons. So, our landscapers and our leasing agents and maintenance guys didn't have to run around all over town. They're within the same block. We own half the block, a quarter of the block, and it had to be inner city because the old density days, you can only build buildings, apartment buildings in inner city Calgary or Edmonton or Regina, Saskatoon. So all these inner city locations, we had clusters of buildings. So 100 right here, 118 buildings right there in inner city Calgary. So that's how we clustered our buildings for operational reasons. Then it evolved to inner city millennial lifestyle. So the inner city millennials, which was the last big boom we've had. All these young people want to live inner city near the bicycle path to entertainment district, universities, colleges, and near Starbucks or whatever. They want to live inner city. They don't want to live in burbs. So we became the provider of funky inner city boutique apartments. And now Blue Sky of Main Street is now those inner city low density buildings where you can tear down 40 units and build 400 units. And that is the valuation of our portfolio. Now, it's happening as we speak. We don't know which stage it's in. We've got, recessions, tariffs, economic slowdown, immigration, and development will probably slow down. But that doesn't take away the embedded value on Blue Sky Main Street's balance sheet that nobody talks about.
So those are a few of the main buckets of value that exist in Main Street now. But for the listener, as a real estate company, you kind of have two options when you're starting out. You can be a company or you can be a REIT. You decided to go down the company route. So that's the version where you don't pay out a lot of your earnings in the form of dividends to investors, if I'm correct. But has that made it so that there's less attention on the stock, and maybe one of the reasons why people don't know about Main Street as much, do you think?
Multiple reasons. There's never one reason. Number two is we wanted to be a pure equity play.
Yeah, exactly.
From an investor's perspective, you got 40 REITs to choose from. Mm-hmm. And there's industrial REIT, office REITs, hotel REITs, any REIT you want, right? So I'm going to go into a very competitive REIT environment, or I'm the only Corp. Mm-hmm. So from an investor, retail or institutional perspective, I want a pure equity, Warren Buffett, add value, accretive, double-digit return.
Which is what you done.
Which I am. Or I want my 3% or 5% where the rest of the REIT is. Second thing is you talked about, we implemented a small, insignificant dividend to open up, because a lot of the funds, retail-based funds, cannot invest in Main Street because we don't give a dividend. So we started giving a small dividend so these portfolio managers can check off this box. And that was the right decision because it's created more liquidity, more volume, and has added a lot of names to the Main Street stock. So they were restricted before, and now there's less restriction on it. So I wanted to give a clear distinction to the capital markets and the investing world. Here, you've got 45 guys, and here's got one pure play, equity play.
Seems obvious to look at it, but do you ever think about converting to a REIT? Have you ever thought about that? Or even going private even?
Well, let's talk about converting to a REIT. Why I do not want to convert into a REIT is the opportunity in the mid-market add value segment. One important ingredient, and go back to curry chicken again, one important ingredient is the mass universe trades below replacement costs. What that means is to build a brand new apartment building, it'll cost you somewhere between $350,000 to $400,000 a door. Now with the tariffs, we don't know how high it could go. Then there's cost of debt, labor ability, cycle time to get development permits. So there's a lot of factors that determines the construction costs. And for a developer to build a brand new apartment building, he needs $2,500 to $3,500 rents. Yep. He needs big rents. But 60% of all Canadians make less than $50,000 a year. So for that reason, the average rent of Main Street is approximately $1,200 to $1,300. Our workforce, average Joe, Walmart buying Canadians, we provide them affordable workforce, quality, affordable workforce accommodation. The point there is our cost of acquisition is somewhere between $100,000 to $150,000 a door. We just did a deal for around $85,000. Why that's important is the risk of our business. What is the risk of our business? Is supply and demand. 101, right? We will not get new supply till rents go up considerably. and to rents to go to $2,500 to $3,000, then you can justify new supply, right? And you can buy it $100,000 a door, $100 to $150,000 a door, while new supply costs $350,000 to $400,000, and a cycle time of 5, 6, 7 years. Who knows how long it takes to get development permits right now. And now with tariffs. And now immigration and international students is slowing down to Canada because of policy changes. So this is a macro fundamentals that is very important for investing public to understand. This is a crunch of affordable housing issue. Cost of new and 10 years of wage deflation and inflation has made the replacement costs go up while the wages didn't go up. So in this unique cycle time, Main Street is consolidating below replacement cost, very low interest rate, in a very low vacancy rate environment. Why is it low vacancy rate environment? Let me give you some data. In the last, and these are rough numbers I've got in my head. So in the last decade, the Canadian population's almost grown by 6 or 7 million people. And there's 2.2 million purpose-built apartments across Canada, not the mid-market, the whole universe, from Prince Edward Island to Victoria, 2.2 million. In the last decade, the population grew by, like I said, 6, 10 million. Purpose-built apartment grew by 400,000. So look at the big, massive disconnect. Now, I realize there are brand new condos go into the rental pool, basement suites go into rental pool. There are other supply mechanisms that take the lid off. We get that, right? But on one snapshot, one line item, purpose-built apartment grew by 400,000, population grew by over 6 million. And some say 10 million. So where are these people? It's an interesting case study that nobody talks about. If the population has grown significantly, where are they staying? Like that's what number. If I was the housing minister of Canada, that would be the number one thing I'd be doing. Where are these people?
But do you think being a public corporation versus a REIT has helped you, or do you ever think about going back to a REIT or becoming a REIT? How do you think about that?
The business opportunity, it will continue. This is a once-in-a-lifetime opportunity to consolidate apartment buildings significantly below replacement costs. That's the storyline, right? And that's why I'm not a REIT. That's why this runway on my business model will continue till we hit around 60, 70, 80% of replacement cost. Why that's an important number. Then a young guy says, okay, I'm willing to pay $500 more and I want a brand new unit. Or I can't afford $500 more and I want to stay in this Main Street's affordable, renovated, quality apartment unit. So that's a decision till we hit. But when that happens, Main Street shareholders will be so rich.
And staying as a public corporation allows you to keep more money in the company instead of paying it out as dividends, which helps you grow and which is better for shareholders.
I'm the only guy. If you want a pure equity play, I'm the only guy. If you want dividends, you got 40 other people to choose from.
Right. And you've also, like you mentioned, haven't issued much equity, roughly 500,000 shares, 600,000 shares since the year 2000, which is 25 years of equity that's been issued, which is unprecedented. I don't know. There are not many companies on the publicly listed that have done that, which is also good for shareholders.
Right. And go back to the curry chicken, is lots of ingredients that's made me outperform the graph you've got in your hand. Just about every index and Amazon and Berkshire Hathaway and RBC, et cetera, that's one. One is a business model, management team, and our ability to reinvest and add value and grow our net asset value without issuing equity.
So there's the macro factor, like population increases to Canada and Calgary specifically, but there's also some other factors like you discussed, like the rezoning in Calgary, that big opportunity for Main Street. Maybe you talked about it a little bit, but how does the rezoning in Calgary help Main Street going forward?
Going forward, land is going to be worth more than the building it stands on. Developers, because of our location, our strategic locations on aggregating mid-market, smaller 3-story walk-ups all over inner city. You'll see Main Street signs everywhere.
Yeah.
And they're going to, it's a matter of, it's happening as we see. You see cranes at every corner and everywhere there's construction going on where they're going to say, there's no place to expand. I'm going to pay you X for your building.
Right.
And that's going to be a negative cap rate. So what that means is the land is going to be worth more than the cash flow. Now, that's a blue sky. But before we hit the blue sky of Main Street, we got two more immediate returns, depending on what the markets do. And there's a lot of moving factors that determines the market cap on Main Street. One is the NOI catch-up I told you about in mid-40 millions and take a multiple of whatever you want on the multifamily REIT index. That gives you instant capital appreciation on existing market cap. 2 is the $815 million of liquidity.
Right. So maybe what does that mean? I think it's called real title ownership, where you own the land and as a result you can get financing and money out of that. How does that work?
Oh, okay. So liquidity means basically I got $815 million to write checks to buy more assets, to increase the NOI and net asset value, and hopefully market cap of the company. So the question I think, Trevor, you're asking me is, where does the $850 million, it's almost $1 billion for a small company on a market cap of $2 billion. Yeah. Where does that come from? It comes from 3 buckets. Bucket 1 is cash, $250 million approximately cash. And the balance is we own clear title assets, which is on our annual report. And all these clear title assets, which are generally buildings going through transformation, that 12% I told you about that are 12 to 15% on new acquisition, which is going through facelifts, renovation, and they're not market-to-market rents, translates to the balance of the liquidity. So when we place long-term debt on these buildings, when we optimize the NOI, put it through the system, put along through long-term debt, that goes into bucket 1, and we extract the equity out of it, and we take the equity and buy some more buildings. So it's kind of a snowballing effect that's gone from approximately 276 units, which was my personal portfolio, to 19,000 units, almost $4 billion in asset. We've survived low oil prices. We've survived COVID, pipeline fiasco, multiple recessions, high interest rates. We've survived them all.
Yeah.
Because it's a business model. We are not financial engineers where we buy. Sometimes the REITs are almost risk-adjusted bond. That's all it is.
Yep.
And a vehicle to get dividends. We only buy buildings that we can add value to. And what does that mean, add value? Obviously, you buy and below market value. And after we've stabilized it, it becomes market value. So we're adding value and we're creating value. And the only way you create value is by increasing the top line revenue on a fixed cost business.
So in simple terms, for the listener, you buy an undervalued property, fix it up, the value goes up. You can take some of the equity from that, reinvest it into the business, and that's how you've been able to grow without issuing more shares, if I'm correct.
That means if your value of the company keeps growing and the share count remains constant, that's how we outperformed everyone else.
So on the other hand, critic would say, I'm not sure this can continue because I'm not sure about population demographics are going to keep going in Canada and Calgary. What are your thoughts on that? How would you respond to that? The demand is still there?
When people talk about, first of all, there's demand because of the 6-odd million people in the shadow market.
No shortage.
Huh?
There's no shortage.
When there's, government stats saying we got 4 years of undersupply or 10 years of undersupply of affordable housing. What are they talking about? They're talking about we have an undersupply. That's number 1. Number 2, the most important part, we will never get any supply till rents go up considerably. Now, the buzzword of today, and I know where you get into this, is that immigration is going to slow down in Canada. Does that mean 0 or 50%?
Right.
It means 50%. Why? Aging demographics. Otherwise, there'll be nobody left to work. We'll become like Japan, Italy, and a lot of these European countries who are saying, we got nobody here. Do we want to get to that situation? Now, what happened post-COVID was uncontrolled immigration. Now, it's not immigration, it's uncontrolled that created burden on a Canadian society. And I think they may have loosened up the criteria or let people in. Like, I'll give you an example. I don't want to get into this political discussion, but this is a golden opportunity for Canada on this what's that visa called that Donald Trump canceled on tech workers to come in?
H-1B.
H-1Bs, thank you. H-1B visas. We want to diversify our economy. We want to turn Canada into a tech hub. Technology is it. And all these H-1B visa guys are going to be going back to where they come from. Here's an opportunity for Canada. Now we require a statesman to say that I'm going to bring in immigration just for tech workers. I don't know if they're going to do it, but if they did it, it would be a golden opportunity. We're going to reflect back 10 years from now while Canada could become Singapore. And we are diversifying our economy. Right. We've killed our resource industry on capping production, and we've done everything possible to shrink our resource economy, but without really helping the other end. But this is an opportunity that's dropped on our lap, low-hanging fruit on just policy changes. Or whatever, we climb back immigration. Let's say, okay, all for 2025, 2026, there's only tech workers coming. I'm okay with that, right? So we got aging demographics, so I don't think they're going to kill immigration. Now, international students. International students is how our Canadian universities balance their books. Now, the presidents of the universities are going to be going to the government to subsidize their education, Canadian education, or they got to slowly ease in international students. They said it was a 2-year ban on clawback of 35%. We don't know, but I'm saying, how do you balance the books of the university? And the greatest form of immigrants are international students. They got to pay the dues, and it's a trade surplus where these international students bring in hard dollars into Canada. They get educated, and most of them stay. And don't you want a big educated workforce who haven't done any criminal activity? They've not made any mistakes. They've been good Canadian
citizens.
Yeah, citizens for before they get their PR card or their citizenship, they've got to wait 8-10 years. Yeah. So you got 8-10 years to test drive this car before you say, okay, I want to buy it. So I think logic will come. Right now, it's policy decisions based on popular vote, stop immigration, stop international student. Third pillar is international workers. The reason international workers exist, our millennials will not work for minimum wage at Tim Hortons. That's the bottom line. They're not going to. They'll rather,
start a podcast.
They do podcasts, develop apps, parents' allowance, live in their mom's basement. They won't do it. So if international workers stop, which have stopped right now, the data is showing that they've paused or slowed it down, there'll be a business uproar in a year, 2 years saying, listen, we got to shut our doors. Do you remember in the last cycle when they shut down Tim Hortons and Jasper and all these places because they couldn't get workers, right? Fort McMurray. And we'll see the same movie again. And there'll be an uproar among the business communities that we can't do it. Now, I do agree with Doug Ford's comment about it should be more provincial because it's sometimes very difficult to monitor what's happening in Yellowknife versus Ottawa. And there's a shortage of workers in Fort McMurray, Yellowknife. And if we truly unleash the energy corridor, I hope it happens, we need workers. Without workers, you're not going to get anything. And you need healthy competition in the workforce. Otherwise, our productivity will continue to drop.
So in other words, you're not worried about demographics and demand for Main Street's product. Long story short.
I'm not losing sleep for multiple reasons. The amount of liquidity and free cash flow Main Street has, and our average rent is somewhere around between $1,200 to $1,300. If my rent's worth $3,000 and you stop immigration and international students, I would be losing sleep, like Toronto developers are. They're solely dependent on speculation and immigration. on the condos I'm referring to. And a lot of these condos went into the rental pool. So immigration has stopped and speculation has stopped. So now we have a problem in oversupply on brand new condos. I think the number is unsold units are like 25,000 in the core of Toronto.
The interest rates have been going down, which is generally good for business, but do you foresee rates, if and when they go up, as an opportunity for Main Street because you don't borrow much and you can use your own portfolio to finance your activities?
First of all, interest rate is a number one cost of Main Street. So when the interest rates dropped during COVID, we refinanced a portfolio at very attractive rates as low as 1.56% on 10-year money. When interest rates were high, we paid cash for assets.
Yeah, exactly.
Right. But to answer your question, is a countercyclical opportunity today as we speak right now. Why? Immigration slowed, international students slowed, international workers have slowed. Tariffs have put a dark cloud on the future of Canadian economy. This is almost a second quarter of contraction in GDP growth. And what kept us also going in the last 5-6 years post-COVID is immigration. Yeah. Immigration made a GDP artificially go up. So we are very lucky to be living in Western Canada. Resources, oil prices, global demand for it. But if I was a big real estate developer in Ontario today, I'd be losing some sleep.
Which is a good opportunity for you.
That's right. This is a great opportunity for me everywhere because people are concerned about the economy and the future of Canada. And think about it. 75% of our trade is with one country alone. Right? How did we get ourselves into this position? It's a wake-up call for us to diversify our economy and diversify our trade partners. And what's going to happen with the new CUSMO or old NAFTA agreement? That's another dark cloud. So I don't see any real investment, investments falling off a cliff in Canada to start off with. But I don't see any new investment coming in till we've got this trade deal negotiated. What are we going to do with the workforce, taxation, productivity? What that translates into an opportunity for Main Street because of the dark clouds. And this opportunity is a countercyclical opportunity in a product which is a necessity. It's called housing.
Yep.
And it's called affordable housing. So I also think the rates are going to continue to drop because that's the only lever the government has. So what is the number one cost? Interest rate. And I'm happy that I'm in Alberta because our cost of, Americans need our oil, 4 or 5 million barrels a day, goes to the U.S. I know there's pipeline shortages. The thing for the last decade people were beaten up on, which is oil and gas industry, is going to save Canada.
Yeah, it's turning around.
And the economy of Western Canada.
Very nicely, yeah.
That's what I feel.
Pays the bills.
Along with Main Street.
Along with Main Street.
Well, and Main Street's affordable housing.
Yeah. Huge tax base. Depending on who you talk to, the Canadian real estate industry has some dark clouds over it, but I don't know what your thoughts are on that, but Calgary, some reports are saying it's slowing down. Some are saying it's strong. What are you seeing for real estate trends in Calgary and in Canada broader?
Two different answers. When building a new supply slows down, which I think the number is 25%, which is great for Main Street. That means there are going to be more renters. It's a trickle-down effect. And I realize a guy who's buying a $600,000 home is not a renter or $700,000 brand new home, which is slowing down a new supply. I get that. But it's a trickle-down effect. Less supply means less new supply means more renters, number one. Number two, the reason a lot of guys are not buying homes, even when the rates are dropped, is the uncertainty. Uncertainty of their job, tariffs, economy, policies. Are we going to really unleash the energy corridor? There's a lot of uncertainty out there. So if I'm Joe the plumber and I'm in process of buying an $800,000 home, I'm going to put that on a pause.
So that's good for Main Street, but maybe the broader real estate markets are softening a little bit? Is that what you see?
It's uncertainty always softens the biggest purchase of middle-class Canadian. The biggest equity, biggest purchase, and I think 70-80% of the retired people retire because of their home equity loans or home equity they have.
Right.
So it is the biggest purchase of middle-class Canadian.
Sure. What about in Calgary? What are you seeing in Calgary?
One thing that is saving the momentum and the positive energy in Calgary. First of all, we were beaten up for the last 10 years. It was anti-energy, anti-Western Canada campaign, and so people a little bit more positive. Two, as the Canadian dollar dropped, and we trade on U.S. dollar oil, the market's robust. Three, interprovincial migration. Although international immigrants, PR, work permits, international students have dropped significantly, interprovincial migration is very healthy. I mean, people losing their job from Ontario, Quebec, wherever, is coming west. Three things that may happen to make Main Street strong growth for the next decade is, one, they unleash the energy corridor. If they don't, we still are steady Eddie, strong economic growth. Number one economic driver in Canada is Alberta.
Yeah, for sure.
If they unleash the energy corridor, which would be unbelievable for us. Because two, interprovincial migration. People coming west.
Yeah.
Not because of, obviously for jobs, but more so on affordability. Taxes, cost of rent. You can still buy a house for $500,000. You don't have to commute 4 hours on every day, 2 hours to work, 2 hours back. Yep. Taxation, quality of life, sunshine, Rockies. I think you're going to see a lot of migration to the west. Third thing is lower cost of debt, interest rates. So if these three things happen, migration to the west, unleashing the energy corridor, and lower interest rate, which is a number one cost of Main Street, will be a different, and $815 million in liquidity, and 12% NOI catch-up, and the density we have, we will be a totally different company, Trevor.
You'll have, instead of 15 consecutive quarters of double-digit year-over-year growth, you'll have 16, 17, 18, 19, maybe 20. Keeps going.
It'll keep going because of the business model. Mid-market, which is 80% of the universe, add value. The whole universe is 20, 40, 50 years old. They all need tender, loving care. Western Canada, that's another reason, another question you never asked me, Trevor, is why am I in the West? Because all the capital's in the East. Family offices, funds, REITs, deep-pocketed, multi-generational capital. Western Canada, it's Main Street Equity. So there's less competition on acquisition, higher yields because of lack of competition, more opportunities to add value.
Interesting. On the flip side, what keeps Bob up at night for Main Street or real estate in general in Canada?
Two-sided question. What keeps me up at night is economic policies on the richest country in the world. We are so rich. And the greatest wealth of Canada is not oil and gas. It's its people. We have the greatest country with the greatest people. And the biggest loss to Canada beyond economic policy is losing young people. You take this software engineer from University of Waterloo and he packs up his bag and moves to Silicon Valley or Singapore or Hong Kong. The number one expat community in Hong Kong are Canadians. So, what keeps me up at night is obviously when you have the best country in the world with the best people in the world and everything going for us, our lack of clarity on economic policy keeps me up at night. But the biggest loss is losing young people. I see, so my brother, for one, has moved to San Francisco. He's a portfolio manager, and he has no desires to come back. So how many people do you know, Trevor, have packed up and moved to Houston, Dallas, LA, or all over the world, Singapore, Dubai? That's what keeps me up. We don't talk about that. Is our number one export, I think, soon is going to be people. So we take this Canadian, educate them, best people in the world, create this intellectual capital, groom him, he gets educated experience, and then we export him. And he becomes an asset of a foreign country. And nobody talks about that. Now, why do I say Canada is the greatest country in the world? Where an immigrant like me came with no money, no education, nothing, and got educated, worked hard, and I created enterprises, multiple enterprises, but the one I'm known for is Mainstreet. And there's nowhere else in the world, maybe United States, you can come and do that. I don't want to lose that. We don't want to lose that reputation.
Yep. Government just needs to get out of the way. There's one theme that's come up on the podcast, especially for energy, but also for real estate. And we can do better, it seems like.
What's going to kill us other than economic policies and brain drain to everywhere is bureaucracy.
Yeah.
It's choking us. So, right. Does it make sense? First, we export all these people, and then we import other people, immigration, because we have a shortage.
For sure.
Why don't we just keep the people we have?
Yep.
Right? And the bureaucracy. And I don't think Canada has woken up to the reality of our challenges. Is it because, Trevor, we are just rich trust fund kids that it doesn't matter? The country as a whole is a trust fund kid. We'll keep leveraging our balance sheets and without encouraging foreign direct investment, productivity, no bureaucracy.
Well, you realize that, but hopefully our elected officials also do. So, but Mainstreet is an example of a company that is building things. So that is a great update of the company. I don't know. Do you want to get into your journey in real estate, or should we?
I'd like to say one thing, though, that's really important to me.
Yeah.
I'm not giving up on Canada. Young people don't give up in Canada. It's one of the few places on this planet where a young immigrant like me can come and create an enterprise. I said, Canada is still the greatest place on this planet. I'm critical because of the economic policies, but that doesn't mean I've given up on Canada. I love Canada. My journey's that's been my journey, is Canada's given me an opportunity and I want to give back. I want to attract great immigrants and great international students to Canada and maybe potentially show them, hey, I could do it, you could do it.
Let's go back in time to Bob's journey in real estate, your beginnings. It's hard to imagine now, but your very first real estate deal, the mechanics of it. What was your first real estate deal and how did you get going?
Don't forget, when I started out in my late teens and early 20s.
This would have been circa 1980?
1990s, late 80s, early 90s. Okay? When I started out in real estate, who were the icons? Reichmans, Donald Trump. There was no Bezos or Facebook, Microsoft, technology. Resources was kind of controlled by the big 5 or 6 SOs of the world, but it was the real estate entrepreneurs. So I grew up wanting being a real estate entrepreneur, and it's in part of my DNA anyway. You know, Sikh warrior natures, or like warriors or real estate owners. So going back, even a poorest Sikh guy, where my roots come from, the state of Punjab in India, owned real estate. Yeah. Poorest or the poorest Sikh guy owned real estate.
So what was your first deal? What did you do?
I was approximately 19 years old. We bought 2 houses for $32,000 each. It was a foreclosure. I partnered up with another guy who is still a shareholder of Mainstreet and a friend, and we went and fixed it up, and I think I made $17,000.
So you bought the house. A week later, you went in and started working on it.
Right away, started working on it 24 hours a day. And we fixed it up, and we flipped it and made $17,000 each.
Okay, but you had to do the work. Like, it's hard to imagine now, Bob, CEO of Mainstreet, but at the time, you literally had to do the work yourself.
Absolutely,
I think. Right.
But you know what? It's even every building we buy, or although we only have approximately 19,000 units, but we've sold a lot of buildings, and we bought buildings that. In the past that went through. So I've walked every building we've bought. So hard work. Yep. No success comes without hard work. So yes, I flipped those 2 houses, $17,000, and I've been doubling down since then.
So then what did you do after that?
We flipped a bunch of houses.
6 months later? Or?
No, right away. And don't forget, it was, Alberta went through National Energy Plan, and there was a lot of foreclosed homes, and a lot of these had deferred maintenance, and they were boarded up. So it was we used to search titles, talk to the lenders, buy these homes, fix them up, flip them out. Started with nothing and kept aggregating, accumulating a net worth, balance sheet, easy to borrow. We used to, honestly, my first 2 deals, even a decade later, our lenders were loan shark. They call them mezz lenders. They weren't like mafia, break your knees, go loan shark. They had this fancy name called equity lenders, mezz lenders, but they charged loan shark rates. That's who we borrowed of. And that's how we started out my career. And those same mezz lenders are shareholders of Main Street today, 25 years later.
I remember you telling me that.
Yeah.
So you'd borrow the money, your very first deal, pretty steep interest rate, but you'd buy the house, fix it up, sell for a bit of a profit, pay back the steep interest rates, and you just kind of built up from there.
That's right.
That's what you did.
Now, the steep interest rates acquisition only works if you are flipping real estate.
Quickly.
And if for some reason you get in the wrong cycle and the market freezes and you're paying 18% interest rate, you could sink pretty fast. You got to be careful.
You could make enough money on those flips that you could make some profit and pay the
2 months off 18% doesn't kill you, but 2 years will.
Right. So you had to get off it quick.
Yeah, you got to be quick. And don't forget, you're working 24 hours a day. When you're in your late teens, early 20s, you don't think about risk like you look at risk today. You just want to, and you got the immigrant DNA, you want to work hard. I wasn't looking for balance.
No plan B.
No plan B. This is it.
But were you doing that full time, or how were you paying the bills just for like day-to-day cash flow?
One positive of immigrants is extended families. We all live together, me, my brother, my parents. So I wasn't living in a flashy downtown apartment building and have a fancy car or I needed to go out and get drunk on weekends or vacations to Hawaii. All we did was work 7 days a week.
So you had most of your bills covered in that sense?
No, when you have collective bill paying, family members, parents and my brother, and the bills are 1/4 or less. And sometimes when you have difficulty paying your bills, your family comes through. And when you have more, you pay more.
Right. And so you flipped, like, at what point did you have enough money in the bank where things were getting momentum? Maybe your 10th deal? Like, how many years in was that?
No, I'm still living on the edge, Trevor.
Still
working 80 hours a week and, buying assets. We have 22 geographic location and jumping on WestJet and buying buildings all over the place.
But you got momentum. Do you remember when you started to transition into, like, at what point did it become a mid-sized company, for example? What year was that? Like the 90s?
Trevor, I still don't consider myself as a mid-sized company because I don't get respect. I'm going to go back to your old question.
And you did your MBA.
That's right. Education was big in our family. My parents were both very educated. And I went to Richard Ivey School of Business, did my MBA. And an interesting story is I did the Main Street case study, which is available online. And I can send it to you, Trevor.
Yeah.
Did I send it to you? And I did, during my 2-year, I did the Main Street case study, which was finance, operation, marketing, branding, everything. And the professor was so fascinated, his name was Terry Deutscher, who still is a shareholder of Main Street, created a case study, which I used to teach once in a while, till now I'm Dhillon School of Business. They did a case study, and the dean of the business school, Larry Tapp, became the chairman of Main Street when I went public. So all the professors were shareholders, the case study, and I used those 2 years to build a model that still exists today. If you read the case study today, I think I graduated in 1998. I don't remember when. I think it was 1998. If you read the case study, it looks identical to the annual report today. Nothing's changed. Mid-market, add value, Western Canada, improving the life of middle-class Canadian. So get back to your original question, which I don't think I answered properly. The reason we are not recognized or identified as a great company like the graph that's sitting on your desk that you dug up as a best performing company is we don't pay the street. So if you go out there and issue equity every month, everybody loves you.
Yeah, a lot of friends.
Yeah. The Bay Street loves you. They're going to say, this guy's paying the street every week and whatever. But the shareholders don't love you. So which one do you want? Bay Street to love you or shareholders? I want the shareholders to love you, love us, because I'm the biggest shareholder.
Do you remember when you started to realize Main Street was working? Or I guess it wasn't Main Street at the time, but maybe the mid-90s?
There was some, going back to the curry chicken, a couple of ingredients that lucky things happened along the way. And I knew Main Street is working right through when I saw the gap in the marketplace. Gap was, again, mid-market, add value, Western Canada. But a couple of lucky things happened. We had a commodity super boom, when China commented and the oil prices went up and everybody was moving to Calgary. And some years the rents doubled instantaneously. COVID, interest rates dropped to believable level. Immigration, the last 6 years, we've post-COVID, and immigrants, they were all renters. So there's some lucky things that happen, but you got to believe in longevity of your business model rather than hope and luck will, take us through. So, but I like to say, Trevor, is during the downturn, we doubled down. When Alberta was a no-fly zone, we doubled down in Alberta. Right now, you'd find this interesting. BC secondary markets, where 43 or 44% of our net asset value is, there's no bids in BC. Right? We have a buying in Victoria, Surrey, Abbotsford, Chilliwack. It's cheaper in these secondary markets, which was unheard of for 2 decades, than Alberta. I have complete faith in Western Canada so we are counter-cyclical. We would go into markets when there's no bids because we believe in Canada and we believe in these cities.
Usually a good idea. People copy it. How did you stay ahead of the competition through the 90s and 2000s and even now? Because I'm sure there was people trying to copy you.
One thing I knew, if you're copying identical to the Main Street model, which is buying distressed asset doesn't have optimum cash flow. So you're going to be feeding it. So if my competition was raising capital with a high yield to their LP holders, then it's very hard to have a product that's not cash flowing and paying yield at the same time. So that's one reason. 2, we invested, decades in operation, technology and supply chain from Asia on our kitchen cabinets, and have a training center for our team. Because it's basically, if you want to hire an accountant, you hire an accountant who goes to accounting school or finance or engineering school for engineers. To be a resident manager, leasing agent, there is no real school for it. So we have our own little school that we train our team. So you got to invest in systems. And we've invested decades into systems, technology, on building the operating platform. Now, another important investing criteria in real estate is delayed gratification. You invest in the stock market, you're watching your screen and the stocks go up, and you get highs and lows every day. People get addicted to it. Bitcoin, great example. Real estate is compounding every day, most of the time positively. It's delayed gratification. Today's generation would rather swing for home runs than a double-digit compounding return that Main Street's been given.
I also have to ask, did you ever meet the Patels? And for the listener, who is the Patel family and what role have they played in real estate in the States?
Well, that's Trevor. Patels is like Smith. Have you met the Smith family? Okay.
Yep.
And I know you're referring to 40% of all the hotels in USA are owned by Patels. That's not one family. That's like saying Smith.
Okay.
Or Dhillon.
Right. But did you ever encounter them?
There's thousands of Patels in Calgary.
Okay.
Yeah, Patel's not a family. It's a surname, and they all come from a state of Gujarat, and they're very successful entrepreneurs.
Southern India. Yeah. But did you ever meet the real ones in the States? Have you ever?
It's a very common last name, Trevor. It's not like it's not a tribe. It's like a very, very common last name. I bet you if you go into the directory in Calgary, you'll see lots of Patels.
So you never cross paths with the ones that own all the motels in the States?
It's not one family that owns 40% of the motels. It's like
Okay.
Thousands of Patels who own thousands of hotels.
I see. Okay.
Thousands of Patels who own thousands of hotels.
How'd you meet Sam Zell?
Well, I got a letter on my desk. When I read his book called I'm Not Subtle, then we'll see a lot of similarities between him and me. Similarity one, he says, I only buy mid-market, secondary markets with a high yield.
Mm-hmm.
I don't believe in development. I believe buy and blow replacement cost.
Yep.
Number one. Number two, I believe in transparency. I only have glass doors in my office, and my door is always open. There was a lot of other things. I don't want to bore you with it. So I contacted him, and he wrote me a letter saying, hey, Bob, you and me are very similar.
Mm-hmm. And so you got to meet him in the end.
Yes.
Before he passed.
That's right.
To wrap up the conversation, what excites you most about the MainStreet Equity in the fall of 2025?
Another countercyclical opportunity.
Mm-hmm.
The last numerous countercyclical opportunities I've had, we never had the operating platform, liquidity at this scale, and diversified portfolio in 22 geographic location. This is the golden opportunity for MainStreet.
And a quick shout out to the recording studio Ear Candy. I don't record here very often, but today with Bob, we got to do that. So thanks, Ear Candy.